Good morning, welcome everyone. Thank you for being here with us today. Sorry for the delay. We had some trouble in connecting one of our portfolio managers. Hopefully he's gonna come in later on, but we have Fred Batois, who is the portfolio manager for the fund, so we will start together now. We have to admit that this week happened to be more interesting than what we thought when we first planned to have this webinar. And so there are a lot of things to talk about. Of course, I believe that our counterparties, our clients and prospects are very interested to understand how our thought on the investment landscape has changed, considering, of course, both the real data you see from the companies, but also considering the news we've got this week from Pfizer on the vaccine side. So, Fred, thank you for being here today with us, and I let you start to comment on performance and on the market.
Thank you, Laura. Thanks, everybody. Good morning, everyone. So, yeah, interesting week, I should say. Obviously, not the performance we would have liked to have, but the market has been very challenging for the beginning of November with this, what I will say, one piece of news that has caused a massive trauma. We will see that later in some slides in the market, not only in equities, but across markets, gold, oil, fixed income, with massive rotation, huge moves on the bond yields that has caused as well a massive rally in financials. So as you can see on this chart, the market has basically been very weak in October. The market was down 7% in Europe in October for the SXXP and has basically bounced back into the election and has been furiously bullish with a huge move on Monday just after the news. This move is pretty, I will say, unique. It's unique. We'll see that probably. You can move on the slides, Laura. We lost some ground, that's for sure. The idea behind the move is that obviously over the last, since March, April, we were in lockdown economies. The pandemic has caused a huge divergence within and divergence of trends inside the economies. I don't need to really explain. You know that how it works. People were at home using Zoom as we do, go to meetings and so on. It's not only the work from home versus the stay at home that has basically got that has normalized this week. It's not only that. If it was only that, probably for us and for many, it would not have been so dramatic in terms of moves. But it's more, you know, this work from home slash this lockdown situation has caused what I would call second derivatives issues inside the markets, which are not only related to the stocks, which is travel and leisure on one side, and on the other side, technology. It's not as simple as that, and we will see that probably a bit later. But the reality is that, you know, you had an event which happens probably, I don't like to say it and to hide behind the uniqueness of some event, but the fact is at 10 in the morning, the market was, you know, acting in a certain way, and suddenly in a question of matter of minutes, you had basically gold coming off 5%, you had the bond moving massively, oil moving massively as well, and you had an enormous rally in what I will call a mixture between value on one side and growth on the other side, momentum winners and momentum losers, between rate sensitivity and rates insensitive, and these divergences, which were quite large, obviously, in the market, like an elastic, instead of evolving in a gradual way, because of this news on the vaccine, which was way better than everyone would have expected, has caused a huge rebound during the intraday session, and a follow through after that in the following day, you can see that the chart here is showing that the price momentum drawdown is the largest on record, and from far. We had a standard deviation of 10 in terms of momentum. What I will call momentum is using the Morgan Stanley, for instance, price momentum index. So that has basically been a quite a large event. October was a good month for us. We were up 40 bips in a down market. Obviously, we had to give back in an event like that. It was quite unexpected to see something coming out and having such an impact, because the impact was not only between winners and losers, but was much more broad-based, as I would say. Yeah, I think it's basically what we've seen. Probably you can move to the next slide. Yeah, so on this specific one, what's important is what do we do in this kind of situation? So first, we have a process. We stick to the process. So we are not going to change on Monday, Tuesday, and U-turn the entire portfolio because for two reasons. Number one, usually you have a massive overreaction amplified by CTAs, by algos, by lots of different factors. So one, you do not want to do that because the fundamental story of companies is not changing overnight forever. It's not like all our stocks on one side are work from home and on the other side are shorts related to travel and leisure. We had some, but not that many. So it's not only, you don't really have to change your strategy. We are pretty relaxed. Obviously, there are some stress in the day, but we're pretty relaxed with what we do. The way we do it and the process we use, we can talk about it a bit later, is basically not going to change, and it's not changing. What we've done in this kind of situation is you try to listen to the market, you try to reduce your losses, the one that especially are related to longs, which stocks are very, what I would call extended from a technical perspective, extended from a valuation perspective. You try to minimize or to take some profits in some cases, because lots of those stocks which were down were very big beneficiary for us. Like, I could name Logitech, I could name Cellnex. A lot of those names have been very good and helped us to be up pre the COVID situation, 6.7% or so, when the market was down 15. So in some situation, so what you do is you reduce your growth, you reduce some stocks that you think are basically going to be badly impacted for a longer period of time, but not only because of this specific event, because of the fundamental and the relative valuation in regards of the potential change related to a vaccine. Then what you do is you try to reassess in the same time. You reassess your book, you reassess your longs, you reassess your shorts, and then you redeploy. We are in phase 1 and 2 at the moment. The growth is around 105, 103. So it has not really changed. We've traded a bit more than usual, that's for sure, because we're here to basically protect capital as well as making money. And the reassessments of the position has been done on the long side and on the short side. So one way is basically reducing some of those extended valuation and massive beneficiary winners. Not all of them again, because some are not related to that, but the ones that are really very, very related to the pre-COVID, even if we're still in COVID situation. And keeping in mind the balance sheets as well, because you cannot cover all your shorts in the same time. Why? Because some of them are overreacting to a news like this. They are overly shorted. The short interest was very high in some names. So we covered some of them, not all of them, because some will have to raise equity, and we still believe that we can make money by being short. So this is the way to navigate through an event. Has been, in our view, it's a good test. We like making money, but it's good to have a test as well in the book and in the portfolio. And that's what we are experiencing. The good news is, to give you an idea, I was looking today at our factor risk going into the event. We were not like overly momentum, but as I said, the dislocation was not only on the price momentum, it was also on other aspects of the markets. You had some names like LVMH, for instance, which is a growth company, which was up as more than the market on that day. And you had some, what I would call non-value, or you had like value names going down, and you had non-value names that are seen as very cheap, because the chart is very low, but the stocks are not cheap and they went up 20 or 30%. So that's why the risk to be too short term and looking only at an event is dangerous. So you cannot overhaul and change the entire portfolio, because the reality will catch you up. Those companies that have a very heavy balance sheet, that have rebounded heavily, might basically go back to where they were. So maybe we can move on to the next slide.
Yeah, maybe it makes sense to comment on the positioning of the portfolio right now.
Yeah, okay, yeah, interesting question. So coming into the event, we were, if you take just the momentum factor, we were only 0.04 exposed. That means what? That means the 1% change is 4 bips. So the question could be, why was the book acting so badly on the day? As I said, there's two reasons. One is when you calculate the momentum factor, you can use 6 months, 1 year, 5 years. So you take a lot of different perspective on that. So that's point number one. What we've tried to do is to, as I said, reduce a bit some names that were just overly extended and too expensive, and we've added some value on the other side. This slide shows some of our long, some of our shorts. Top 10 on each side is an interesting statistic, but I will just put a caveat on that because we don't have huge positions, and on average nothing is above 2.5. So even Peugeot, which is a large position, this position has helped us along the way. So yeah, on the changes that you've basically asked, we exited some names, we covered some shorts, and the current positioning is interesting because today, for instance, you have a bit of a value, what I would call a value or a momentum rally, and we're still up on the day, despite these momentum factors being up 1.5%. So that means that the adjustment we've made are paying already. My view is to be a bit careful on taking a dramatic view on value versus growth, and on momentum, buying all the losers or selling all the winners just because we've had this event and because the vaccine is coming. So the reason is, I'm giving you one example. In April 1999, okay, you could have said a similar situation happened even if the intensity of the rotation between the winners and the losers was not as big. It was quite a big day, one of the largest day as well. And after this moment, you had 1 year, 1 full year of NASDAQ outperforming the value by a matter of 35%. So anyone at this time who would have said, you know what, it's, just sell the NASDAQ, sell the tech, sell the leaders and buy the value, would have been basically nailed. So it's not what we do. We don't do that. We don't take an aggressive view. We are aware of the fact that when you look at price to book value, when you look at price to earnings ratio, when you look at, for the companies that have earnings, by the way, because we always talk about price to earnings of growth versus value, but in this situation, a lot of companies have basically no earnings on the on the worst kind of situations. So we know that there's a big divergence. We are aware of that. We adjust the book. We've got some Airbus that basically is an interesting position. We've got some Lloyds, we've got some PNP, so we've added some financials. What I didn't talk about is, and it's an interesting point, the reason why it was so painful for a lot of people and so sudden is because the index itself had a massive divergence between themselves. You had the Euro Stoxx 50, which was up 2.5% more than the Euro Stoxx 600, which is unheard of. It's the largest divergence between those two indexes, which means that you had a lot of people playing algos, playing futures. Hence, you cannot take this as a new trend. This is an event. It has happened. You work on it. You adjust your risk. You look at the stock by stock. You look at the situation from a macro perspective. But you cannot take one event and extrapolate the event, saying this is it's finished. The trend that we had is over. So the importance of the process that we have is we screen stocks based on different factors. Factors being fundamental factors being relative price performance, sector relative price as well, so how the sectors move between each other. So the input will tell us anyway if the changes we see on one day will basically last, because we will start to see that financials relative strength will come in. We will start to see as well earnings will start to accelerate on the value side. So we let the data come to us as opposed to preempt and take a massive decision. The book is balanced between growth and value, more balanced than it was for sure, but it has not radically changed. A lot of the names that you see on the left side were there. You know, Peugeot was there, Volvo was there, BNP was there. The weighting is a bit different. Schneider was there, Teleperformance was here. So on this list, there's probably only Airbus that has been added. Other names have been added, but with lower weighting. And on the right side, we've covered some shorts that has been moving a bit more aggressively, because some names that we had were very, very, I would say, some were, you know, quite crowded shorts. So, you know, Laura, that's a bit the way we navigate this period.
Yeah, so maybe, Fred, just a question you already answered. So indeed, do you think that this vaccine news from Pfizer, and of course it might come out also from other companies, will change the leadership into the market into the next 3 months, or not? And indeed, is something you look at, or if I understand well, you stick to the analysis of the fundamentals for each of the companies you have in the book?
So two ways to respond to your question. The first way is the guessing and the opinions, and the second way is the process. I try not to be in camp 1, I'm in camp 2. Obviously, you're not up 7% when the market is down 15 without having some winners and shorting some losers. You cannot do that. Okay, it's impossible. But in the same time, it's impossible not to give back some profits if there is an event which could mean that, as you said, that the regime has completely changed. But the reality is no one knows. No one knows. So if you get sent some research from Morgan Stanley, JP Morgan, all those strategists told us since July or June that some valuation in some aspect of the market, the quality / growth companies that are more, I will say, defensive, visible growth, whether it's software, whether it's technology hardware, whether it's home delivery, they were all telling you this is just too high, it's too expensive over the last 4 or 5 months. If you had listened to that since June, you will have basically bought airports, airlines, travel and leisure, banks, they all went down, and you will have lost a lot of money. So what I'm saying is, and it's not that it's a stupid analysis, there's a lot of very high quality analysis, price to book value of banks versus history, price to earnings ratio based on the recovery of earnings for travel and leisure, and you name it. There's lots of very decent fundamental analysis that could basically have brought you to the wrong conclusion 4 or 5 months ago. So that said, this is the danger of being too top-down, too opinionated. What we try to do is to stick to the process, which the process is more of a, screening the stocks based on criteria, screening the sectors based on criteria which are fundamental, static, fundamental, dynamic. Static because we use return on equity, free cash flow, and those data are not changing every day. Then you have some dynamic, which is the changing quarter on quarter of sales, of earnings, the acceleration of the revision ratios. So those data are more dynamic. We use those things because we can get the incremental. That's point number one. Then we use the relative strength of the price performance, because the price performance relative to the market is for us an input. That means that the scoring will evolve, if you see what I mean. So if value stock starts to have some, relative price momentum, we will start to see it. For now, it's very early. You've had, massive move spike for some of those names in one shot. Then it's drifting down again. So we need to see, and you need to square that with the way we work. We screen everything based on what I would say fundamental, static, fundamental, dynamic flows, so relative price performance, and we score all that, and then we have a list of stocks that we look. So this process is not changing. So to go back to your question about is it a market change regime, and should the answer is I don't know, and I think it's better not to try to guess and to stick to your process to basically evolve and keep your portfolio in good shape. So what you do, and the way we think about the market regime change is we will see how things evolve. What is sure is that if you look at the PMI and if you look at M1, so M1 being the money getting printed, the money getting printed is vertical, and the PMI have shooted up but are diverging, which means that you could think, and that's more of an opinion than a hard fact, you could think that the PMI could reaccelerate. You could think that the reopening of a part of the economy will basically, given the printing press that is in shape, could create a reflationary effect because the capex in oil and gas have been cut, for instance. There's no more capex getting spent. So the supply and demand imbalance with a reopening economy could create some form of inflationary pressure. If that happens, it should favor cyclical value as opposed to growth, and it could create a derating related to the rates and the yield move. If the yield move a bit more than what we've seen, consequently, the high PE stocks could derate a bit, and you could have, you know, a quite interesting rotation between the value, low price to book value, low PE, in favor of them versus the growth. But again, to me, we need to be careful. We have that in mind, on the back of our mind. We address some of the imbalances, and we don't want to be trapped into being too momentum, but we don't want to be trapped into moving to value just on a sentiment and on a guess, because this could happen in 6 months' time. It could be a false start. What if the vaccine is not, you know, as good? What if the economy is reopened, but you know, the travel data are not as strong? People don't move as much. And what if some companies go bankrupt? Bear in mind that it's not because you reopen everything tomorrow that, you know, some companies will not go, you know, be in very bad situation from a balance sheet perspective. So, you know, that's why for us, we need to keep it balanced. We have added more value in some names that we think are super interesting and showing some relative strengths, but we are not completely changing the portfolio 180 degrees. You just don't do that. You do it gradually.
Perfect. Just a question from the audience on the chat. So they see that, of course, there is a lot of growth into the industrial sector. Why is that? Are there more interesting opportunities on a relative base side?
What was the question? I missed.
There is more growth exposure into the industrial sector relative to the others. Why is that?
Well, this, I think in the industrial sector, this is a bit overstating the 5.7, because we have as well an SXNP, which is an industrial short. We short the sector, which I'm not sure it takes this into account in this slide. I was just thinking that some of the sector short, probably not. So it's not a 6%, it's less than that. We are probably 3% net long industrial, so it's not very big, as big as what you would think. We've got some interest in industrial longs and industrial shorts that are based, again, on fundamental, quantamental, what I will call, and also, you know, our technical scoring. Some of the industrials have been very good for us. You know, we had Schneider, Volvo for a long time. Peugeot is a name that is much bigger now than it was. It's a very cheap company. They're going to merge with Fiat, which you probably know more than me about, but there's a massive amount of synergy between the two. If you get a bit excited and you look at, you know, the valuation, you could get to 2 to 3 times EBITDA for 2023. So you know, with no synergies that are, in my opinion, very high. When you calculate the synergies announced and you divide that by the combined cost structure and you compare that with all the different deals that you've seen, it's not crazy. So again, industrial is a good example of mixing value, Peugeot and probably Volvo, with a Schneider, which is not value, with a Linde, which I will call more of a chemicals, but it's inside industrial and it's not. It's a bit more expensive. So we've got, you know, a mixture of things. Airbus is quite a new position. We want to have a bit of exposure to what I will call good balance sheets, and it's a duopoly. Whatever you do, you know, even if you are in a double dip in airlines, those you know, Airbus had surprised recently on the deliveries. They were better than what people were expecting. So just to mention a few names, an Airbus will be a value stock, a Peugeot will be a value stock, Volvo will be in between. It's not expensive versus history, but the stock has done really well. And Schneider is what I would call a proper re-rating story. Schneider is an amazingly well-positioned company in you know, whatever the area you look at, it's super well-positioned in ESG. It's you know, the organic growth during this period has been stunning. They managed to, you know, surprise on that note, and I think it's 5-6% organic. So, but it's not a cheap name. So again, when you look at the book, you try to say that we've had some big winners. Some of those winners have re-rated. Okay, Schneider is an example, and we've got some stocks where we are a bit bigger now that have been lagging, are much cheaper, but we cannot sell the winners just because they've re-rated. If I give you one example of why you cannot sell just because it's expensive and because the stock has done well. So a lot of people say price momentum. Okay, the stock has done well, I sell it. Well, it's not as simple as that. If you take Teleperformance, for instance, we've had this stock since, you know, almost when I joined. It's one of the companies that I like the most on the market. And on the day, the stock was down 6%. The market was up 4%. It's already recovering. But if you look at a company like this, why is it down? It's down because the momentum has massively changed, and you had all the CTAs working and so on. But the fundamental of the company, we're not talking about a company which is on, you know, 20 times EV to sales. It's probably a 13 times EBIT company. So it's not super expensive, and it's growing 8 to 10%. So buying value when there's zero growth, it can be very dangerous as well. That's my point. And also bear in mind, Laura, one point regarding your question on industrials. I will give you one example of what is going on in the market. If you take, for instance, a stock which we don't have, which I looked at it and I was thinking, should I buy before this problem? Should I buy a bit more laggards? So companies that have come down doing an L and is like this. Should I buy these companies? And I looked at, I'm trying to filter stocks constantly. And if you look at airports, so you take Aéroport de Paris, airport from Paris, Charles de Gaulle, Orly. You look at the valuation of this company. So the stock is on its knees, it's down 80%. But when you look at the valuation, you realize that it's on 22 times recovered EBIT. So the problem of saying you know, we buy value, it's not because the stock is very low and the stock is very depressed that is value. The stock is super expensive, and a lot of the reopening trade is expensive. So to be honest with you, we don't have a lot of stocks which I would call the reopening stocks, for two reasons. The first reason is what I said. A lot of them seem destroyed from a chart perspective, but are not very cheap because the market expects a massive rebound of the earnings, if you see what I mean. So you need to be very careful with the term bad momentum and value. You can be in very bad momentum, being down 80%, but being very expensive.
That's very clear. Fred, let's go to say our roadmap. So what are the main features we are looking at also for next year's, and that identify the fund and the way that you manage it?
Yeah, I like the slide actually. The reality is that we took over this fund in December. I joined in February. Tellworth is a company that had been set up by Paul and John, very solid people who, you know, I'm really happy to have joined them. I was basically working before at Chilton. For those who don't know my background, we were part of I was part of a team which was nominated for the awards in 2019. It was a long shot, but not market neutral. And I was in charge of a couple of sectors. Today, the job, and since I joined, we already accomplished a lot. The chemistry between Paul, John, and I is very good. Paul is very experienced, and he's helped me as well to go through this test. He said, earlier this week, I said, I've never seen something like that. It's so hard. He said, don't change the way you manage, don't change the way you work. We have a process, you apply the process, and you adapt to the process, but you don't change the process. So this year, obviously, things were going pretty well for us up to this event, and I'm convinced that nothing is going to change. The reason is the process don't need to change. The process takes into account the changes between value and growth. As I said, we will see the earnings coming, we will see the expectations coming up, and we will see if the value is a fallacy trade or a real trade. And we will move along the way. We will add value names if our scoring system shows that there's more values scoring well. So that's the idea. So, we are in November. We've now, I believe we're going to see from now on how earnings are going to be for Q4, but more importantly, how the Q1 and Q2 will evolve. And the process is scalable because what we do is very scalable in terms of stocks. We don't invest in very small caps, so it's easy to find. I would say, or not easy, but it's replicable process, and we combine bottom up and top down. So I think that whatever the environment, we need and we should, and I'm pretty confident in the fact that excluding one-off event when you have a 15% move of the momentum factor or something like that, you don't have that every day, as we know. And I'm pretty excited about 2021 because we'll see the balance of style, the balance of regime. We will see exactly through our process and our way of screening what will come up. Paul is specialized in UK, so he's on top of things regarding the Brexit situation. The internal view is that there should be a deal, and if there's no deal, if you look at the price of the UK, and by the way, the MCX, so the mid-cap UK index, has acted much better recently than any index. So it looks like there's a lot of negative news that has been priced. We have more stocks related on the long side than on the short side. We are pretty neutral, I think. I need to look at that again regarding the Brexit, but we are careful not to be shorting the domestic too much. Reason is there should be, as I said, a high chance of a positive outcome, whatever happens, because the UK is one of the cheapest, if not the cheapest market in Europe. On any metric you can look at, PE, price to book, and the underperformance of the UK index has been very high, especially in the mid-cap level. So yeah, we're excited about 2021. It might be, 2020 has been and is still a massive, unique kind of year because of this COVID situation. But maybe 2021 will be the road towards normalization, and hopefully it will be done in a way which will not be as abrupt, but probably a bit more, things will just converge a bit more between the two sides of the markets.
Perfect. So I think we pretty much give an overview on what happened and, more importantly, what's our roadmap for the future. So thank you very much, Fred. Thank you for your time, and thank you for the time of our clients that participated today with us. Thank you, everyone. Have a nice weekend.
Thank you very much. Thank you, Laura. Bye.
Bye.